Alright, today is Monday, March 15th, and this is a post-market review for the stock market activities today. We witnessed the calm before the storm. In today's activities, very choppy. Initially in the morning, we saw the market trending lower. We saw a massive dip, but the dip was immediately bought, and we saw the indices closing at the highs of the day. All in all, muted activities in the 10-year yield, and therefore we saw the indices following the path of least resistance. Another thing that was very interesting in today's activities is the mini sell-off that we saw in the energy and financial sectors. Meanwhile, in technology and momentum names, we saw certain names rebounding higher, only modestly, and others continuing to trend lower. All in all, the market is acting as we expected heading into this week. We are still in the calm before the storm period because we have the FOMC meeting on Wednesday, and the market is anticipating the outcome of the meeting. In addition, the stimulus checks continue to arrive to bank accounts, and that will take a few days before the money finds its way into the market. So we know that we have a massive storm coming, up or down, depending on the outcome of these two events, the FOMC meeting and the arrival of the stimmy checks into the market. We will cover everything from the market dynamics, the technicals, the macroeconomic news, and dissecting market participants' psychology by analyzing the action in the options market. We will do that and a lot more. But for now, I have a market to cover. And here we go. The Dow Industrial Average closing in the green by 174.82 points, or a gain of 0.53%. The Nasdaq in the green by 139.84 points, or a gain of 1.05%. The S&P 500 also in the green by 25.60 points, or a gain of 0.65%. The bulk of the gains were made during the last hour of the day. We saw a massive surge higher, and I think I know what happened there. Moving on to the sector's performance. Leading the pack at number 1 and capturing the gold medal, real estate. At number 2 for the silver, utilities. And at number 3 for the bronze, technology. Meanwhile, the laggards of the day led by energy, financials, and materials. So we saw some profit taking from the inflationary trade of energy, financials, industrials, and we saw some of that money rotating into the rate-sensitive sectors of the market, whether we're talking about utilities or technology, even though the move was not a significant or notable rotation. I see it as strategy shift right before the FOMC meeting. Moving on to the futures market performance for the day. We saw modest declines for crude oil futures. What about softs? We saw gains for lumber and OJ futures. Meanwhile, we saw declines led by coca, cotton, coffee, and sugar futures dipping in the red just slightly. And what about metals? Gains across the board led by silver, platinum, palladium, gold, and copper. Gold finally catching a break. Could it be? Will it be? We will see during the charts analysis. For now, let's see what happened in meats futures. Gains led by feeder and live cattle futures. Meanwhile, we saw declines for lean hogs futures. And what about grains? Gains across the board led by corn, soybean meal, wheat, soybean, and canola futures. The decliners among grains futures are soybean oil, rough rice, and oats futures. Interesting activities for metals, specifically going higher along with lumber, scoring more gains and adding more to the inflationary fears. We have to watch the futures market because it will give us indications regarding the inflationary picture. Regardless of the day-to-day manipulations that could take place in the dollar index or the bonds market, futures market will always tell us the truth. And for now, the inflationary expectations are not going anywhere. Moving on to the big casino, the options market, and let's see what took place today. We saw a slight pickup in volume, indicating the beginning of the re-entry of retail traders back into the casino to make more wagers, assuming that the corrective storm that took place in the market the last few weeks is over. We will see if this assumption is right or wrong. But the other assumption is placing bets in anticipation of a stimmy rally. We know that the stimmy checks are starting to arrive to bank accounts, and by next week we will see those stimmies already in Robinhood accounts ready to be deployed, and therefore the stimmy optimism has a longer shelf life than the FOMC optimism, which has one more day left. But for now, coming up number one, and the hottest table in town, Apple, with 1.3 million contracts trading in the market today. About 78% of those were calls. At number two, AMC, with about 1 million contracts, and about 70% of those were calls. At number three, American Airlines, with a little over 500,000 contracts. About 78.5% of those were calls. We also saw an improvement in the put-to-calls ratio, specifically for Tesla and Palantir, two of the names among the retail crowd's favorite names. Yet another indicator of an upcoming tsunami of stimulus money chasing call options. Moving on to the unusual activities that took place in the options market today, starting with AMC. And the trade here is a bearish trade. We know AMC ripping higher today. Somebody's betting on a reversal by buying the $13 puts, expiration date March 19th, meaning this upcoming Friday, with expectations that AMC will decline over 7% by then, and they paid about $1.10 a piece to enter this trade, bringing the total to about $3 million. And what about the trade for the ticker XRT? This is the retail ETF. And the largest holding in this particular ETF is GameStop. So it is an indirect way to bet for or against GameStop. In this case, they're betting for GameStop and the XRT in specific by buying the 100 calls, expiration date March 26, with expectations that the name will gain over 11% by then, and they paid $1.35 a piece to enter this trade, bringing the total all the way to $2 million. And what about the trade for the ticker M for Macy's? Yet another large component of the XRT. So perhaps we have a theme here, because they're buying the 23 calls, expiration date April 16th, with expectations that Macy's will gain over 11% by then, and they paid $1.15 a piece to enter this trade, bringing the total to about $1.5 million. What about the trade for the ticker MTCH? This is for Match, the owner of Tinder. We know since Bumble entered the arena of investing in the stock market, it is becoming the hottest ticket. People are buying Bumble and fading Match. In with the new, out with the old. And in this case, they're buying the 130 puts, expiration date April 16th, with expectations that Match.com will decline over 15% by then, and they paid about $1.70 a piece to enter this trade, which brought the total all the way to $1.5 million. And what about the trade for the ticker SQ for Square? We have a big bet here by buying the 270 calls, expiration date March 26, with expectations that the name will gain over 7.5% by then, and they paid about $4 a piece to enter this trade, bringing the total to about $3 million. Continuing with interesting trades. What about the ticker VIAC? This is for Viacom. We talked about this name yesterday as a potential shorting opportunity, and I did short it in the morning today. And somebody's making a massive bet here, agreeing with me by buying the $90 puts, expiration date April 16th, with expectations that the name will decline over 6.5% by then. They paid $7.50 a piece to enter this trade, which brought the total all the way to $5 million. And if you thought that is a lot, wait till you hear this upcoming trade for the ticker BA for Boeing. We also talked about this name during the previous previous video last night, and we covered the chart, and I told you that Boeing is looking bullish here. And somebody's agreeing with me by buying the 295 calls expiration date May 21st. With expectations that Boeing will gain over 11% by then, they paid about $12 a piece to enter this trade, bringing the total all the way to $8.5 million. And here is the last trade I want to cover with you for the ticker SNOW for Snowflake. In this case, they're making a bullish bet by buying the 282.5 calls expiration date April 1st, with expectations that Snowflake will gain over 18.7% by then. They paid about $4.10 a piece to enter this trade, bringing the total to about $2 million. And now, moving on to the headlines that shape the day, starting with macro news. And right away, we were anticipating the Empire State Manufacturing Index, and we received this information in the morning. The Fed's Empire State Manufacturing Index hits 8 months high in March, yet another indicator that the ongoing recovery is happening faster than expected. And of course, it's all done under the stimulation, the artificial stimulation of the economy via the tsunami of liquidity. And this faster than expected recovery will result in inflation. And here are the details. The New York Factory Index rises to 17.4 from 12.1 in February. Price paid index highest in 10 years. So they're paying more for input prices, and they will pass that extra cost to us, the end customer. Inflation is already here. It's not a conspiracy. It is already here. We also received data from the TSA regarding the health of the travel and airline industry, and the number of check-ins in TSA gates reached the highest level since the beginning of the pandemic. Furthermore, U.S. airline stocks rose Monday after a number of carriers reported strong demand for seats from leisure travelers, meaning that there is a massive campaign of vaccination taking place right now. And when people get vaccinated, they are emboldened to travel, and we are seeing a recovery here in airlines travel, specifically for leisure. And we have spring break underway, so there is a lot of traveling going on. The problem is, what happens to all of these stocks once investors realize that higher oil prices are here to stay? And here it is. Speaking of air travel, the CDC chief warns of another COVID surge as Americans travel for spring break. And if we do indeed see a spike in infections, that will take all of these reopening names down, because we will see massive selling in these names, because the current prices and valuations for these names are insane. They are trading above their pre-pandemic highs, and any dent in the story of the speed of the recovery and reopening will indeed cause a sell-off in these stocks. Furthermore, it could be what the Fed needs to calm down the bonds market. A surge of reinfections will cause yields to dive lower. On the other hand, the Federal Reserve is also pushing for higher inflation to speed up the economic recovery. So the Federal Reserve is a very confused organization. They would love to see a surge in COVID cases for yields to go down. On the other hand, they don't want an event like that to derail the pace of the recovery. Once again, a situation of wanting your cake and eating it too. You're not going to have higher inflation not accompanied with higher yields. If you want higher inflation because you believe that higher inflation will speed up the economic recovery, well, that would come hand in hand with rising yields. There is no a la carte when it comes to macroeconomics. And speaking of inflation, what about the stimmies? What's going on with the stimmy situation? Here it is. Americans ready to plow 10% of stimulus checks into Bitcoin and stocks, survey says. And expect these Americans to deploy their stimulus checks by buying the dumbest stocks out there. Meme stocks, Bitcoin, Dogecoin. All of these things will blast higher because dumb money will follow dumb things. In the meantime, we make money from the dumb moves. End of story. But perhaps there's a problem here because some taxpayers say that the IRS Get My Payment tool indicated that their third stimulus check was deposited into a bank account that isn't theirs. So somebody else got your stimulus and they will use it to buy meme stocks instead. And I have an idea on whose account your stimulus went to. And of course, if your stimulus check went to Kim Jong-un instead, don't bother trying to get your check back by calling the IRS, because they could give a rat's ass about you getting money. But when the tables are turned and you are the one who owes them money and you don't pay, they will take you to jail. Unless you are rich enough. Here it is. The IRS has failed to collect more than $2.4 billion from wealthy individuals who owe the U.S. back taxes, according to a watchdog report. And the wealthy, of course, they have been getting away with not paying taxes for years and years and years. And here is a hedge fund billionaire, Bill Ackman, is donating $1 billion to charity. Oh, how generous of you, Mr. Bill Ackman. What a good man. Oh, wait a minute. Ackman, in a tweet, said he was a day one investor in Coupang and is gifting his 26.5 million shares to 3 nonprofits, including the Pershing Square Foundation, a philanthropic unit founded by Ackman and his wife Karen in December of 2006. You know, the rich have these cute tricks where every one of them has a charitable foundation, and you think these people are so generous. On the contrary, they use these foundations, these nonprofits, as a tool of tax avoidance, because they'd rather give the money to their charitable foundations and have control on where the money goes rather than paying the government, so the government can use that money to pay you bums, your health care, your education, and all that stuff. Bill Ackman doesn't want to pay for that. Bill Ackman would rather direct his own money the way he sees fit. And of course, don't be surprised if you hear that the Pershing Square Foundation is the buyer of a certain NFT in the future to launder the money back to Mr. Ackman. Out of the billionaire land and back into the land of bums. What's going on in average Joe and Jane's world? People holding U.S. mortgages saw their equity rise by 16.2% year over year in the fourth quarter, largest annual gain since 2013. Combo of price appreciation, home improvement, and cheaper rates, allowing for refinancing, helped add 1.5 trillion to aggregate wealth. So apparently we are richer than ever before, because the value of the houses that we're in right now, our assets, they're huge and round and firm and nice. So we are exploiting the opportunity by taking loans against our assets. And this is the smart way to do it. The only problem is that when the tide turns and we have interest rates surging higher, all of a sudden you find yourself refinancing at a higher rate but a lower value on your property, meaning that we will see a lot of casualties here if we see the housing bubble bursting suddenly, specifically if the needle that pokes the bubble is higher rates. And what we're seeing here, of course, is typical of a surging inflation in the economy. But rest assured, the Treasury Secretary, along with the Federal Reserve, are putting their blindfolds on, their earmuffs on, and they are denying the existence of inflation. U.S. Treasury Secretary Yellen, U.S. inflation risk remains small and quote-unquote manageable. Moving on to sentiment news, starting with the tulip mania of the 21st century. Bitcoin. India to propose cryptocurrency ban, penalizing miners and traders. And we saw Bitcoin prices diving lower today, and the mania has gotten out of hand. South Korea's crypto exchange market volume surpassed the nation's stock exchange market. This is quite insane. Indeed it is. People have more money than to know what to do with. They're locked up in their houses, they can't go out, so why not gamble and play this video game called the stock market and the crypto market until the game is over. And not everyone will be a winner when the game is over. And perhaps these crypto maniacs need to secure their quote-unquote digital wallets, because hackers stole NFTs from nifty gateway users. And of course, wait till Kim Jong-un cleans up your digital wallet. And all of a sudden you're crying, "Whoa," asking the government to bail your ass out, asking if your money is insured. And the government would say, "Oh, wait a minute. Are you talking about dollars?" "No, I'm talking about Bitcoin." "Oh, I'm sorry, sir. That stuff is not insured. If you had that worthless fiat currency and that got stolen from your actual wallet in the bank account, then your money is insured. But when it comes to cryptos and digital wallets, we refer you to the North Korean embassy." And I know it just triggered a bunch of crypto bros. That's okay. I still think Bitcoin is going higher. So at least we agree on that. But here is more about the incoming tsunami of steamy money into the market. Retail investors could buy a record $3 billion of US stocks the day they get their steamy money. One research firm says, once again, there are a bunch of zombies high on meth waiting at the gates to stampede and buy those stocks. Just feed them the tickers and they will go heads first, Naruto style, with their blindfolds on, stampeding all over the place like a bunch of grasshoppers. And what are they gonna buy? Meme stocks, Bitcoin, Dogecoin, SPACs. Whoops, here it is. Bearish bets against SPACs have more than tripled to about $2.7 billion from the $724 million at the start of the year, S3 Partners said. Well, here's another thing for you maniacs from Wall Street bets. All of these shorties are hitting SPACs, so why don't you use your steamy money to pop these SPACs higher and show the Wall Streeters and stick it to the man. Show them how the common man can beat Wall Street by making Wall Street richer. Continuing in market sentiment news, what about Jim Cramer of CNBC? Here is why Jim Cramer says he still doesn't like high multiple tech stocks. So according to flip-flopping Jim Cramer, you're not supposed to buy the dip in these high multiple tech stocks because they're still overvalued. So you can listen to this Jim Cramer. Let's call him Jim Cramer number 1. Or you could listen to Jim Cramer number 2 from a few weeks ago, specifically February 24th, when he said buy the dip, and the overvaluation is actually in names like Caterpillar and the inflationary names.
What is now the state of this tech trade? Look, I've got to tell you, I thought that 947 bottom yesterday, some people say it could be put in by Kathy Wood. I felt it was important to mention her name because it's still 12 o'clock. We haven't gone to 12:01 yet. I felt that bottom held. I felt that this is one of those moments where you can start looking at stocks. I got to tell you something here, Scott. Zoom down 40, Lulu down 23, DocuSign down 23, Xilinx down 20, AMD down 20. There are things to buy. And we can sit here and say, well, tech's got expensive. What's expensive is one of my favorites, Caterpillar. I mean, I'd rather take a look at a DocuSign down 23 than I would a Caterpillar up 100. So anyway, that's where I am.
Not in the tech and high valuation names. But again, the pancake tastes the same. Whether you flip it up or down, it doesn't matter. It's still Jim Cramer, meaning that your pancake is full of shit. More in sentiment news, and here is the market indicator that bulls love, but suddenly turn bearish. So recently, are the bulls gonna listen or not? Because here it is. The measure was developed by the great Yale economist Robert Shiller, who calls it the excess CAPE yield. It is an extension of Shiller's legendary CAPE, or cyclically adjusted price to earnings ratio, which measures whether stocks are under or overvalued by historical standards, to eliminate the peaks and valleys that can make equities appear cheap when earnings are inflated or pricey when earnings crater, but are bound to rebound. Shiller uses average profits over the past decade adjusted for inflation as the denominator. The numerator is the S&P 500 index. The bulls don't talk much about the regular CAPE because it has long been flashing red. Right now it stands at 35.65. The figure exceeds the peaks of 33 in 1929 and 28 in 2007. So we are reading the highest reading ever, flashing red warning. So the traditional CAPE is signaling that a big correction is far more likely than a durable uptrend. The excess CAPE yield, however, incorporates the enthusiast favorite argument for why big cap stocks are by and large still a great buy. It factors in long bond interest rates, which until lately have hovered in incredibly low levels. Those ultra-slender yields provide ballast for the position that as long as stocks look much pricey than bonds, investors' money is bound to keep pouring into equities. Bonds prices move inversely to their yields, rising when yields fall. In its more intellectual form, the argument holds that the plunge in treasury yields starting late 2018 substantially lowered the discount rate applied to future corporate profits. By basic math, a lower discount rate raises the present value of a given stream of profits and greatly boosts stock prices. Seems to make perfect sense. So once again, these hyper bulls criticized the original CAPE yield that it doesn't incorporate the new era of cocaine, the new era of low interest rates from the Federal Reserve, and in turn lower yields. And that argument held for too long, that the excess CAPE yield now factors in the risk-free rate. But now even this new indicator that caters to the hyper bulls is flashing red. And of course, yields are an important factor in this indicator because the lower yields sink, the higher we can push stock prices, because the TINA argument and because lower yields amplify the present value of future profits. But when yields start to turn higher, then the present value of future earnings are diluted, and therefore you have to cut the multiples in stocks that went higher based on future earnings. You know, the future bro names, companies that have no profits, sometimes not even revenue, but the donkeys and the Robin Hood idiots push them higher anyways. They had an argument on their hand that the risk-free rate is lower, and therefore future earnings, it doesn't matter if they will happen or not. So long as we're calculating future earnings, and the present value of these earnings is higher and higher. I'm talking to you Tesla, I'm talking to you Blink Charging, I'm talking to you all of these garbage stocks that went higher based on the future bro argument. Well, now the future bro argument is down the toilet. The rub that incredibly low rates essential to the bulls' rationale have to stay low to prove them right. And that scenario has hardly ever happened. Now we are witnessing the trend that was likely from the start, a rebound in yields to much more normal levels, especially given the roaring economy the bulls see building. Indeed, the two views that resurgent companies will be thirsting to expand in flush times ahead. That despite strong demand for capital, rates can keep setting at historic lows seem to contradict one another. How does Wall Street's prized benchmark look today? Inflation is now running at 1.61%. in a seismic shift that is a hair below the 10-year yield of 1.62%. Suddenly, real rates aren't negative anymore. They're flat. In the meantime, the S&P 500, despite some jittery days, has ignored the surge in the 10-year to reach fresh highs. That rise, of course, has lowered the chiller's earnings yield. At the same time, real rates rose by over a point. As of March 11th, the earnings yield number had declined from 3.25% in September to just 2.81%, the inverse of the CAPE 35.6. Meaning that even when you factor all the arguments and the complaints from the bulls regarding critics of this market rally when they bring valuation metrics, etc., the bulls, or in this case the pigs really, because bulls are more rational and they know when to take profits, but the pigs stay there forever, to the moon, bro. And the pigs are saying, oh, you can't look at valuations the traditional way because things are different now. You have to factor in this list, A, B, C, D, whatever Fugazi demands they have. Well, now, even when you factor in all of these complaints and excuses, the indicator shows that the stock market is overpriced, even with factoring in all the excuses and the demands from the pigs. The best time to buy stocks is when rates are unusually high and PEs are unusually low. The current picture is the opposite. The economy will get back to normal, and that would seem to be good news for the bulls. Pay attention now, but it is not. Stocks will go back to normal too, and that will be a bummer. Only wise people will understand this statement. What did we say when we covered the Biden portfolio a few months ago? That the current policy and strategy of the economic recovery will be good for the economy, but what's good for the economy is not good for the stock market anymore. Moving on to corporate-specific news. And what a shellacking AstraZeneca got the last few days. Germany, France, and Italy have joined a group of smaller European countries that have temporarily stopped administering the AstraZeneca vaccine. Here is what you need to know, and what you need to know is that a lot of people got blood clots and died from the AstraZeneca vaccine. And I know that everybody's going to brush this news as, oh, it's just specific to AstraZeneca and we don't have a problem otherwise. We're already vaccinating. We're going to reopen in a little bit. No problems. Everything is hunky-dory. Be careful of this assumption because we still don't know how another spike, specifically from a new variant, will impact the economic recovery picture. We are in the uncharted territory. Expect the unexpected. And of course, AstraZeneca said it found no evidence that its COVID-19 vaccine increases blood clot risk. Of course, they didn't find any evidence. They made the damn vaccine. What about the souffle? Tesla. Tesla is in a race with VW, targeting battery costs and gigafactories. And by the way, VW is coming back with vengeance. They're about to smack Tesla like you have never seen before. Tesla's been sitting there in the ring, alone, having the whole ring by itself. All of a sudden, Mike Tyson enters the ring, and that is VW. And I know what the culties are gonna say. Oh, what a clown this guy is. Seriously, VW compared to Tesla? Well, that's not me saying it, baby. These are the quote-unquote experts. And all I know that VW has a lot more experience and resources to combat Tesla and emerge as a serious challenger. And the opportunity here, if I'm trying to chase the EV mania, would I buy Tesla right now at over 1,000 PE ratio, or would I buy VW stock, which is trading dirt cheap, even after the massive surge it experienced the last few months? And here is more bad news for the souffle. GM backed Cruise to buy self-driving startup Voyage. And of course, we know that Reverend Elon Musk promised robo-taxis by 2019. Well, where are the damn robo-taxis? Because every culty I debate, when I bring up Tesla's valuation, they remind me of, oh, but what about the robo-taxis? That's $1 trillion business alone. Yeah, where are the robo-taxis? Because it looks like GM is about to beat Tesla in the robo-taxi and self-driving initiatives. And here is Kia flexing their own muscles. Kia shows off first full images of the new EV6 electric cars. And we know that the iMob over at Apple rumored that they're talking to Kia and Kia and Hyundai to design their cars. Of course, they denied these rumors, but now we have all of a sudden Kia emerging with a new picture of a new electric car. So was this supposed to be the iCar? Who knows? And of course, the souffle is not just facing competitive threats, but they're also not making any money for years and years and years. And now their margins are about to be squeezed due to the rise in raw material costs, lithium, cobalt, etc. But rest assured that the CEO, the leader of the cult, His Eminence Elon Musk, Reverend Elon Musk that is on top of everything. Tesla has now made more money by buying and holding Bitcoin than in 13 years of selling cars. So the Rev is gambling with the money, and it is paying off for now. But you might want to be concerned about the mental health of Reverend Elon Musk, because in an SEC filing, Elon Musk adds Techno King of Tesla as a title. And they changed the CFO's title to quote-unquote Master of Coin. So I'm not sure if these kindergarten kids leading the company or not, but certainly sounds assuring that we have some mature leadership over the souffle. And I'm not entirely sure about the Techno King title for Reverend Elon Musk. I don't like it. I like the Grand Master Chef of all souffles, His Eminence Reverend Elon Musk. Moving on to the heat map analysis, and let's see what took place today. What are the themes in the market? Number one, it is notable that we saw some profit taking from energy names and financials. Not a lot, but notable. ExxonMobil down over 2.5%. And I do believe that if the dip continues for ExxonMobil, that would be an opportunity to buy. Likewise, in banks, we didn't see a lot of losses. JP Morgan, Bank of America down about half a percentage point. But we saw Berkshire Hathaway down about 2% or so. So it is notable now that we saw a slight sell-off in these inflationary trades, and we saw a bid for technology and high growth, high momentum names. But again, it is not a rotation because it's very small. The industrial sector, for example, managed to outperform significantly. We saw Triple M up over 2.5%, GE up over 6%, names in defense and other industrial names such as Caterpillar, Deere, Hubbell, all of these names were trading in the green, meaning that there is some profit taking here and there in the inflationary trade, but not very noticeable. The reopening names, the reopening trade remains very hot. Airlines, casinos, cruises, all trading in the green. In technology, we saw a rebound in Apple. That is very notable because I keep telling you, as Apple goes, so will the market, meaning that the Qs, the Nasdaq, were actually trading in the red earlier in the day. Meanwhile, Apple stayed trading in the green. That was your indicator right away that was a bear trap and the Nasdaq will bounce higher. As Apple goes, so will the market, specifically the Nasdaq. Some gains across all technology sectors, software, semiconductors, but they look as weak gains, meaning just recovering from the knockdown punch, standing up on your feet before getting punched again. Congratulations, you got up from the KO, now you're on your feet, but you're not stable, and here comes Mike Tyson again. We also saw notable activities for certain names, such as Eli Lilly. Eli Lilly was down over 9% today because of bad news regarding their Alzheimer treatment. Of course, they pushed the stock higher like a bunch of maniacs, the donkey mentality of buying first, asking questions later. And they bought based on the Alzheimer cure optimism. We now know that that one is a bust. And now the questions are being asked. Buy first, ask questions later. Matter of fact, don't ask questions at all until the stock drops 10% in a day. Let's check on some of the themes in the market and see what's going on here. Perhaps we can have and get more insights. Here is the reopening trade, aka the nostalgia stocks. Mixed picture here, but mostly in the green. Some modest losses for Chevron, American Express. We saw gains being taken out in the financials and energy names, but the reopening names remain intact. It is a very, very hot trade. What about the high inflation trade? Once again, modest declines from certain names, but still finishing with good performance. Names in real estate such as WPC up over 1%, Newmount in gold up over 4% today, gold making a comeback, Kroger up 1%, Hubbell and Deere all up over 1%, but we saw modest declines for JP Morgan, US Bank, Boeing, Alcoa, UPS was down a little more, and perhaps we will see a buying opportunity if we see UPS continuing to dive lower. Now, what about the deflationary trade? Gains across the board with only two names, GM and DoorDash, closing in the red. Once again, a very humble, very modest bounce across the board for names like Tesla, Square, Shopify, ServiceNow, Peloton, Okta. Now here's the thing, and here's the $1 million question. Did what we see today in the market of selling energy and financials and placing bids in the beaten down deflationary names in the high growth, high momentum sector of the market, is this sustainable? This mini tiny baby rotation we saw today, is it sustainable, and is it the start of something bigger? That will depend on the market's interpretation of the upcoming FOMC meeting. For now, my strategy is, at least from an options positioning, that I do have more puts than calls, but I do have calls in case the market starts to bounce a little higher. And the way I'm doing it is shorter term calls versus longer term puts, meaning that I do see the bounce continuing higher for a little while, and I do want protection from that, so I am buying calls expiring short term. But absent of any tangible change from the Federal Reserve in terms of policy regarding the rise of yields, then we will resume trending lower. And therefore I have longer term puts. Moving on to the charts analysis, starting with the SPY 15 minutes chart. What do we see here? Boring activities today, nothing is going on as expected. The slow grind higher with very low volume. The path of least resistance during low volume is higher. We saw some funny business intraday with a big dip in the morning that was bought right away, and we had a massive pump higher by the end of the day. What's up with that? Can we read anything from it? Not at all. It is a sharp move higher, but the volume was not that significant. And the assumption is that we're seeing some short covering taking place in the market in anticipation of the new FOMC meeting and the STIMI checks. Two things guiding the market this week: the FOMC and the STIMI optimism. What about the big picture from the daily chart of the continuous contract? What do we see here? We closed slightly below the all-time high and the resistance target of 3,960. We closed at 3,956.75. So we are getting there, and the assumption here is that we will be able to break above it. If we reverse before breaking above it, oh boy, that would be a really bad signal for the S&P 500. But usually the reversal happens after a sharp break higher over the resistance target and then a reversal intraday, aka gap and crap. We don't have that yet. From this chart, looking at it right now, the SPY should go higher. And what about the Q's 15 minutes chart? Similar story here, almost an identical look, no difference whatsoever. We paid 313 the attention and the respect she deserves, and now we're flying back higher. The volatility will come in the aftermath of the FOMC meeting. For now, it is smooth sailing. What about the continuous contract of the Qs, the Nasdaq? We're seeing sort of a bull flag consolidation that is supposed to take us higher. And my target is recapturing the resistance in the purple trend line. That would be a point and a battle for the Qs to win. Moving on to the IWM 15 minutes chart. Once again, it is a meme ETF and it is bouncing higher based on large moves in very speculative names. The problem is that we saw a flush down at the end of the day for GME, GameStop. How would that impact the IWM tomorrow? That remains the question. But we saw the Russell underperforming the indices today, and the reason is GameStop. GameStop flushing lower at the end of the day and the indices shooting sharply higher. What's up with that phenomena? It is very interesting, and perhaps the algos are looking at GameStop as a certain indicator. I'm not sure about that, but the moves are very, very peculiar. Zooming out, daily chart of the IWM. What do we see here? Nothing is going on. Autopilot buying, gapping higher. The momentum is very strong. The reversal will be very sharp in this particular index, but we don't have a signal for a reversal yet. A reversal, in my opinion, will take place in the IWM in two scenarios, one or the other. Both involve gapping higher and then reversing lower intraday, aka gap and crap. But if we see more pain in GameStop overnight, and let's say another crash for GameStop, then the IWM could open gapping lower, and that would be the top right there. For now, we don't have any reversal signal. Notable weakness in the weekly charts, the long-term charts, but in the daily, no signs of alarm. Moving on to the Dixie. Moving a little higher today, but still facing the resistance of 92, and it is looking weak here, the dollar index that is. It needs to consolidate a lot more. Here's what's going to happen. If you see consolidation just a hair below 92, understand that the US dollar is about to head higher because consolidating so close to the resistance line is gathering energy to blast higher. And we have a resistance in the trend line in yellow. However, getting rejected over and over from a resistance line and trending lower is a sign of weakness. And if that is the case, then we have lower prices for the US dollar. Perhaps 91 will hold as a support. We will see more buyers pushing it once again to challenge 92. But the battle right now is still not clear. Today was another rejection day from 92. We'll see what happens tomorrow. And once again, expect jittery trading for the US dollar in anticipation of the FOMC meeting. And that in turn will affect the prices of gold. What's going on with gold? The bounce is still holding, and we are seeing the bull flag formation starting to play out. I do believe that higher prices for gold are coming, but I hate to be repetitive here. It all depends on the outcome of the FOMC meeting. if the dollar surges higher in the aftermath of the FOMC, then gold will go lower. But perhaps, as we discussed yesterday, gold is paying attention more this time around to yields than to the dollar index. So the outcome on yields will be more important for gold. Yields surging higher once again, gold will go lower. Yields dropping lower for whatever reason, I'm talking about Jerome, then gold will rise higher. And what about Bitcoin? What do we see here in Bitcoin? Obviously, a big drop overnight, continuing in the session today. But still, that did not change anything. We have a series of higher highs and higher lows. Nothing changed whatsoever. We know more stimmy money is about to chase Bitcoin, so I still retain that Bitcoin will trade higher, perhaps all the way to 68,000. That outlook will change if we see a development in the charts, meaning a reversal/bearish candlestick pattern or making a lower low. For now, we don't have that signal yet. If we receive one, I will update you. But for now, the trajectory remains higher. Perhaps Bitcoin is still upset about the news from India and the ban on cryptos, etc. And perhaps there are fears that other countries will follow through. For now, we don't have any technical damage. If we start closing below 52,500, we will start to see technical damage. Moving on to the TNX yields. What do we see here? Bull flag, playing higher, and now just consolidating, waiting for what? Waiting for the outcome of the FOMC meeting. Are we going to have a decision from the Federal Reserve regarding yield curve control in one way or the other? That will push the TNX lower. Or are we not going to have a decision, which is the likely outcome, that we don't expect Jerome Powell and the Federal Reserve to enact any policy decisions right now. They might address the problem and say something more meaningful than Jerome Powell's notable comment when he said, oh, the rise in yields is notable, quote unquote. Perhaps they're going to elaborate a little more and give the matter the attention and the concern it deserves. But I doubt that they will take specific decisions, meaning that the TNX for now, the trajectory is higher. This is the calm before the storm. And what about the TLT? Not looking good, not bouncing higher meaningfully, and perhaps the TLT bulls will catch a break from Jerome Powell and the Federal Reserve if they enact policy to manipulate the yield curve. In other words, perhaps the Federal Reserve this week will give Stephen Van Meter a break. What about the VIX? The VIX going all the way down to 20. And perhaps this is an explanation beyond that massive candle we saw in the market right before the close. I heard on CNBC Mike Santoli saying that perhaps the indices surged higher algorithmically right before the close as soon as the VIX touched the magic number of 20. The algorithms believe that the VIX go down to 20. That means that we have a blow-off top kind of rally. We will see if that's going to happen or not. But the VIX is trending lower because volatility is dying in the market in anticipation of the FOMC meeting. Moving on to Apple. What do we see here in Apple land? 15 minutes chart. Once again, we are departing from the 120 support, and the next destination is 125. That would be the resistance. And of course, Apple should not gap above 125. It should pay 125 the respect it deserves by hanging around the area of 125, consolidating for a little while, rechecking for support before moving higher. Because if you do gap higher in Apple's chart overnight, remember, the center of gravity for this chart is 125, meaning just like we saw with 113 in the Qs, you're not going to be able to gap above it without coming back to recheck it for support. Similarly, Apple cannot move past 125 by gapping higher. It needs to pay the respect that 125 deserves. Moving on to Tesla. And let's check on how high the bounce can go. The obvious next destination is 720. That has been the sticky point, the resistance, and we reversed from this level before. Now we gather more energy and let's see if we can crack 700. If that happens, then the next destination is about 760 bucks. But once you go to 760, it will start getting stretched once again, and absent of any Federal Reserve policy, then the trajectory should reverse lower. And perhaps we will reassess at that point and enter a new short position for Tesla if we reach 760 Moving on to the conclusion of this video. What do we have in the economic calendar tomorrow? We have the retail sales that would be very important, specifically for retail stocks, the XRT, and the health of the consumer, in addition to the inflationary picture. Are we seeing more spending, a significant surge, a modest surge? That will make a lot of difference. Now, let me finish by answering some questions from the viewers, specifically this question. I have two questions. Number one, the graph you are showing for the Nasdaq long term looks like a gigantic cup and handle chart. Can that be? I'm not sure what you're looking at here, but you're probably referring to the daily chart of the Qs. I see a bull flag formation. You could be seeing a cup and handle. It doesn't matter. It is a bullish formation that should take us higher. And the next question is, looking ahead into the long-term future, I believe that artificial intelligence companies will play a significant role. Wouldn't it make sense to start buying stocks like Palantir, down significantly from the highs, that will play a role in this field, or Google? Thanks for your answers and your daily efforts. Well, artificial intelligence is already here, and it will be a main driver for the theme in growth in the 2020s. Now, you have to factor in the entry price, because in any successful investment, the entry price makes the bulk of the difference. We can have one great stock, let's say Tesla, surging insane amount higher. Somebody bought the stock at $100. The stock went all the way to $900. And let's say that Tesla stock gets a haircut and drops 50% from the highs. The stock is now trading around $450. For the person who bought the stock at $100, they still look like investment geniuses because they bought cheap, and the stock, even after the 50% drop, is still returning triple digits return. Meanwhile, somebody who is chasing the mania and buying the stock at $900, $800, $700, well, a 50% drop from the highs will mean a lot of pain for them, even though we're talking about the same stock. So the entry price is perhaps 50% of what dictates the success of any investment. In the case of Palantir, yes, Palantir is here to stay. I don't doubt that at all. The problem is the valuation. At the highs, the company was valued at around $80 billion. That is absolutely insane and out of touch when you consider that the company just made only $1 billion last year. And if you're gonna say, oh, the future, bro, this is exactly the problem, because as yields continue to go higher, future earnings, the present value of these future earnings, become diluted by the day. So yes, Palantir could have a bright future ahead of it, but you cannot value the company based on future earnings alone anymore, and that would take a lot of valuations lower. The higher the stock departs from its fair value, the bigger the correction for that particular stock would be under an environment where rates are rising higher. Now, what is the fair value for Palantir? We could spend days doing research and calculations to figure that out. People pay thousands of dollars to get that kind of research. But I ask you, is Palantir still a good deal at these prices when the forward PE ratio for the stock is hovering around 129? That is an insane valuation. Likewise, what about the price to sales ratio for Palantir? It is sitting at around 44. That is highly elevated. More expensive than Tesla, more expensive than Zoom, more expensive than a lot of the mania names, making Palantir very, very expensive. Google, on the other hand, is trading at around 8 times price to sales ratio. That is a lot better than Microsoft, Facebook, almost as close as Apple's price to sales ratio. When we talk about the forward PE, Google is trading around only 25, a lot cheaper than Palantir. So once again, apple and oranges. But you also have to keep in mind that Palantir is growing faster than Google and has a lot more future earnings growth than Google. So don't expect both of them to have the same forward PE ratio or price to sales ratio. But what is fair in this case? Palantir, 44 times sales, it is out of whack. So perhaps we will see lower prices here for Palantir, regardless of the bounces and the pumps. And the question is, are we seeing the beginning of a head and shoulder formation in Palantir that would drive us lower below 19? That is a possibility. So you have to be careful here. And even if you want to buy the stock at these levels, buy in increments. So you buy a little more right now. If the stock goes higher, you're going to feel smart. If the stock goes lower, you're going to feel dumb. But at least you have more ammo to buy more and average down. down. At some point, the stock reaches fair valuation, the market decides that, and it bounces higher and starts trading in a new bull run, perhaps more reasonable and more rational than the impulsive rally the stock had during the current mania. Anyhow, that's all I got for you today, and I do have my portfolio analysis video coming out. I did record it during the weekend. I need to edit it. I will do that tonight, and the video should be out to you in the morning. I apologize for not finishing the video during the weekend as I promised, but once again, you start doing these daily market recaps and some work has to be delayed. But I will finish the editing and I will get that video out to you as soon as I can. That's all for now, and I'll talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.